Let's now take a look at some interesting trends and statistics in the real estate industry, as well as what happened before, during, and after the 2007 US mortgage crisis. The purpose to study real estate in this class is to make informed decisions regarding real estate. You may wonder if real estate is important in general, or specifically if it is important to you. Here are some statistics that show the importance of real estate. As I mentioned before, real estate touches everyone's life. The statistics you see on the slide come from an earlier version of the textbook. Although I have not updated the data, these statistics are still very interesting. First of all, in 2002, real estate was the single largest component of wealth in our society. The market value of non-government-owned real estate was about $22 trillion. U.S. publicly traded corporate equities or stocks were only $13.3 trillion at that time. At that time, real estate also accounted for about 5% of the U.S. gross domestic product, the GDP, which represents the total dollar value of all goods and services produced in the U.S. over a specific time period. You can think of the GDP as the size of the economy. Back then, it was estimated that real estate created jobs for over 9 million Americans and was the source of 70% of local government revenues. Governments receive income from real estate through fees and real estate taxes, as owners of properties have to pay annual property taxes based on the market value of the property while they own the property. Also, every time a real estate transaction and a mortgage transaction occurs, the government receives income through fees and taxes. You can clearly see that real estate is an important part of the U.S. economy and affects everyone: individuals, families, companies, and governments. Real estate is not only important in the U.S., but also very important for the global economy. In 2015, for example, the value of all developed real estate in the world, that includes all residential and commercial real estate, was estimated to be worth about $217 trillion. That means the value of all real estate in the world is 2.7 times the world's GDP. The value of our global real estate also exceeds the value of all global equities. That means stocks, and securitized debt instruments, that means mortgage-backed securities, by 1/3. Interestingly enough, China accounts for 25% of the world's residential real estate and the US for about 21%. For China, that number is not surprising, as China also makes up about 20% of the world's population. For the US, however, that number is quite high, as the US only has 5% of the world's population. On the commercial side, North America makes up about half the world's real estate value, while Europe makes up about a quarter. I want to turn your attention now to some statistics directly related to the real estate market downturn during the 2007 US mortgage crisis, or the burst of what many called the real estate bubble. This graph shows the values of the S&P Case-Shiller Index between 2000 and 2018. The S&P Case-Shiller Index is the most popular and widely used index representing home values in the US. As you can see from this chart, the height of the US real estate market was sometime in early 2006, according to the average values of the largest 20 metropolitan areas. In early 2018, values were finally back to the peak 2006 levels. There are many reasons why the 2007 mortgage crisis occurred. I will point out some of the most important ones. One cause of the crisis that is oftentimes cited is the greed of the banks that made the mortgages. As home values were going up, each loan transaction made the banks money. As the banks made more loans, they also earned more profit. borrowing requirements by the banks were very lax, and no government laws existed with respect to minimum loan requirements. In fact, the riskier loans made the banks more money, so the banks had an incentive to make risky loans. Here are some examples of risky loans. Subprime adjustable rate mortgages are loans made to high risk, or also called subprime borrowers, where the interest rate adjusts to a current interest index every year. Negative amortization loans are also risky loans. They are loans where the borrower can pay an amount of interest that does not cover the current interest rate payment on the loan. The difference between the market interest rate and the interest rate the borrower actually pays gets tagged on to the loan amount. Therefore, the borrower can potentially owe more and more over time, and owe more than the house is worth, and be underwater. This is what happened to many borrowers, especially once the market values started to decline. No-doc or stated income loans, which also have the nickname of liar loans, risky loans because the borrowers only state their income but do not have to prove their income through documentation. These were particularly popular with people who earn cash tips, such as waiters and valets, and who oftentimes do not report those tips as income. Another type of high-risk loan is the high loan-to-value loan. This is a loan where the borrower puts very little money down. In some transactions, borrowers were even walking away with money in hand, as they were able to borrow over 100% of the home value. However, the greed did not stop with the banks, and many borrowers hopped on the bandwagon and borrowed beyond their means. Many people who could not even afford the payments on one mortgage bought several properties and ended up with multiple mortgage payments. The feeling among most home buyers at that time was, if you buy a property, you will certainly make money. If you touch real estate, it will turn into gold. Those times actually reminded me of the gold rush. That is called market exuberance. Some also cited the government's actions as a cause for the mortgage crisis. The US government promotes home ownership because home ownership creates stability in the community. In particular, due to the promotion of equal rights, the government encouraged low-income minorities to take out loans. Some argue that these risky borrowers would not have been able to qualify for loans if it had not been for the help of the government. Also, appraisers oftentimes overvalued properties, which exacerbated the problem of rising home values and helped cause a bubble. Appraisers were often put under pressure to come up with a high valuation, as bankers and real estate agents threatened to withhold future business if the valuations did not meet their expectations. As it was easy to get loans, many investors bought real estate as a quick investment but ignored the costs of holding real estate. This was particularly true for properties before their construction started. If a buyer commits to buying a property pre-construction, the buyer typically has to put down about 10% of the property value to secure the property. However, at the time of the closing, the difference, the remaining 90%, and the carrying costs have to be paid. Carrying costs include taxes, insurance, and utilities. Paying those funds is not a problem for the investor as long as the property can be quickly flipped before or right after the closing. But when the demand let up in 2006 for new properties, many investors could not afford to hang on to those properties that they had secured pre-construction. They had to sell them off quickly, often at a steep discount. This set a downward spiral of real estate values in motion. Also, before the 2006 bubble, interest rates and insurance premiums were generally low, which made real estate a very affordable investment. But after 2006, both started to rise, especially the insurance premiums in Florida, as the state had just weathered several hurricanes. One of the reasons the crisis went global was because banks were able to sell the loans they either made or bought through a process called securitization. This way, mortgages were sold off as mortgage-backed securities, MBSs, to investors globally. These investors were all too happy to buy what they believed were U.S. low-risk real estate-backed investments. In addition, the rating agencies such as Standard & Poor's and Moody's, which are in the business of rating the risk of the mortgage-backed securities, underestimated the inherent risk of the mortgages. In addition, they were under pressure by the banks to give the securities high ratings, or the banks threatened to not use their services in the future. And finally, banks took on even more risk by entering into credit default swap agreements, which are insurance products that insure the default of the mortgage-backed securities. An interesting coverage of these insurance products is part of the book by Michael Lewis, The Big Short, which was also made into a movie that was released in 2016. Now let's move on to some of the consequences of the 2007 mortgage crisis. With the drop in home values, many people suddenly owed more on their mortgages than their homes were worth and were upside down. Many borrowers had overextended themselves due to a lack of lending requirements. This led to many defaults on mortgages as borrowers could not afford to pay their mortgage payments anymore. As a consequence, millions of homeowners were forced into foreclosures or short sales and lost their homes. We will talk about foreclosures and short sales in a later chapter on mortgage financing. Hundreds of lenders in the U.S. that specialized in subprime loans filed for bankruptcy protection or were taken over by other banks. One example of a lender that made and held many subprime mortgages on its balance sheet was Countrywide, which was bought by Bank of America in 2008 in the middle of the mortgage meltdown. This deal ended up costing Bank of America tens of billions of dollars in losses. Many large U.S. financial institutions were in financial trouble during the mortgage crisis. The collapse of Lehman Brothers in 2008, for example, was one of the largest financial institution failures in U.S. history. Goldman Sachs was also in financial trouble due to failed loans and mortgage-backed securities, but was surprisingly bailed out by the U.S. government in 2008, along with the help from the firm Berkshire Hathaway. Goldman Sachs has paid billions of dollars in settlement charges to the U.S. Justice Department over its mortgage bond sales practices. The panic about the U.S. banks then also spread to U.S. equities in general. The U.S. equity markets dropped by over 50% between November 2007 and March 2009. Many people saw their retirement portfolios shrink dramatically and either had to delay retirement or go back to work after they had already retired. This panic then also triggered a lack of liquidity in the financial markets as lenders stopped making loans. It was an incredibly difficult time as companies and individuals could not get any debt funding. This in turn negatively affected the overall U.S. economy. Companies started to fire people and stopped hiring. As many people lost their jobs, the unemployment rate went to over 10% in 2009, up from 5% in 2005. The effects of the U.S. financial crisis then spread across international borders. This was due to the securitization of loans into mortgage-backed securities, which were bought by many international banks. International banks that suffered losses during the financial crisis were, for example, the British bank Northern Rock, which was taken into public ownership in 2008 and bought by another bank in 2012, and the German bank Sachsen Landesbank, a state-owned bank that was taken over by another state-run German bank in 2008. The ratings agencies which provided misleading ratings on the mortgage-backed securities were sued by the federal government and settled legal claims worth hundreds of millions of dollars. As mentioned, the budgets of U.S. states were also affected by the financial crisis, in particular the Florida state budget. The state of Florida earns a lot of money from real estate transactions, as well as real estate property taxes. After the mortgage crisis, the number of real estate transactions decreased significantly, and therefore also the amount of fees and taxes charged for these transactions. In addition, real estate values dropped, and therefore also the real estate taxes that are charged by the state, as taxes are calculated as a percentage of a property's value. The decrease of the state's income due to the mortgage crisis caused a reduction in the Florida state budget, which had a dramatic impact on the Florida education system. Florida universities cut many staff and faculty positions, reduced their employees' pay, and raised tuition on students. During the mortgage crisis, the U.S. government tried to lessen the effects of the crisis on homeowners and stepped in by creating the Troubled Asset Relief Program, TARP, and the Making Home Affordable Program. But in general, these programs only helped a limited amount of homeowners and were generally perceived as a failure. The problem with these measures was that banks were only encouraged, but not forced, to help owners with their mortgages by allowing either lower interest payments or by reducing the loan amount. In their greed, banks were often more likely to foreclose on their home and face a high loss rather than work out a more affordable solution for a homeowner. Lastly, former President Obama signed the Dodd-Frank Act into law in 2010. This act created many new regulations in the finance, banking, appraisal, mortgage, and real estate sales industries, some of which we will discuss in later chapters. This law was supposed to eliminate the systemic risk in the financial markets and prevent another financial crisis from occurring. Today, many of the provisions of the act are still in place.